Welcome to the research desk.
We are looking today at a company that defies almost every conventional assumption about how you build a dominant generational brand.
If you ask the average consumer about Progressive Insurance, they immediately think of the television commercials. They picture the pristine white aprons, the cheerful retail aesthetic, the name tags.
The upbeat mascots.
Right, exactly. But beneath that highly polished, very friendly consumer veneer lies an incredible paradox. This is a company that built an absolute financial fortress. And they did not do it by skimming the safest, wealthiest, most predictable customers off the top of the market.
No, they didn't. They built their empire by explicitly and methodically serving the exact drivers that every other legacy carrier actively rejected.
And I look at this structural phenomenon and I see a triumph of pure, cold-blooded underwriting discipline. In a market that fundamentally lacked mathematical rigor, Progressive just mastered the unglamorous mechanics of the business.
I think unglamorous mechanics is understating what they actually pulled off, though.
Well, they perfected combined ratios, they tightened claims loops, they built an actuarial architecture that could profitably process the messy, complicated risks everyone else tossed aside. The story of Progressive is really the story of operational pragmatism taken to its absolute mathematical limit.
See, I view their trajectory through a completely different lens. If we strictly view Progressive through the mechanics of traditional insurance, we miss the actual magnitude of what they accomplished.
How so?
Because I'd argue that at a certain point in their history, Progressive actually stopped being an insurance company entirely. When you trace their evolution, they fit perfectly into a broader pattern we see across multiple industries, the information edge pattern.
You're saying they became a data company?
Exactly. They became a behavioral data science machine the exact moment they realized they could measure risk more precisely than the rivals. The insurance policies were just the monetization vehicle for a compounding informational advantage. They were no longer simply pooling risk.
They were running a continuous, high-resolution behavioral experiment on the American driving public.
Precisely.
Well, that fundamental tension is what we are going to unpack today. How did two pragmatic lawyers in Cleveland, Ohio, operating back in 1937 without major capital, turn the ugliest, most undesirable risks in the market into a blueprint for a corporate machine, a machine that by late 2025 commands 38.6 million policies and staggering financial margins?
To understand this, we really have to start at the very beginning, at that initial blind spot in the market.
Right, so imagine you are a driver in the late 1930s. The entire auto insurance industry is operating with this blunt instrument mentality. Legacy carriers wanted standard risks, they wanted stable households with predictable records, distributed cleanly through legacy agent networks.
If you missed one insurance payment, or if you had a minor infraction on your record.
Or if you drove a commercial delivery truck instead of a family sedan.
Right. To the big insurance giants, you were radioactive. They simply walked away. They either charged absurdly prohibitive rates or outright refused to quote the business.
So when Joseph Lewis and Jack Green founded Progressive Mutual Insurance Company, they were not these grand technology pioneers. They were lawyers lacking the capital to outmuscle the established giants.
They looked at the drivers the incumbents rejected and didn't see toxicity. They saw a discarded market that could be priced.
Because the prevailing operating assumption of the 1930s and 1940s was that the risky end of the market was intrinsically unprofitable. And because everyone believed it was toxic, it became this self-fulfilling prophecy.
But Lewis and Green identified a fundamental flaw in human categorization. They realized that the established carriers were looking at non-standard risk as a monolithic bucket.
Right. Think of traditional insurance in that era, like throwing a giant net into the ocean. You catch tuna, but you also catch old boots and tires, and you just average out the cost of dragging the net.
If a driver fell into the non-standard bucket, traditional insurers viewed them as an old tire. Progressive's initial conceptual leap was recognizing that non-standard is not a bucket at all. It is a spectrum.
And their early operational inventiveness reflects a profound pragmatism in dealing with that spectrum. Let's just look at their physical operations. They opened what was effectively the industry's first drive-in claims location.
Which sounds minor now.
It Sounds like a minor customer service tweak from a traditional business analysis perspective. But look at the underlying mechanics of how claims were handled before this. If you had an accident, an adjuster had to schedule a visit, drive out to a location, perhaps your home or a tow yard, assess the vehicle in an uncontrolled environment, and process the paperwork manually over weeks.
It was inefficient, highly subjective, and, honestly, rife with fraud.
Exactly. So a centralized drive-in claims location is a brilliant stroke of cost control. It standardizes the physical inspection, it speeds up the processing time, it builds immediate trust with a demographic that historically distrusted financial institutions.
I agree with the operational efficiency, but
Wait, let me just add, we see this same operational genius in 1964 when Progressive became the first insurer in Ohio to offer payment plans to non-standard auto policyholders. Traditional insurers looked at irregular customers and saw chaos.
because they couldn't write a check for an annual premium up front, which was the industry standard.
Right. But Progressive saw a basic billing friction to be solved. They applied a simple credit strategy to smooth out the cash flow of a volatile demographic. They needed to collect premiums from people who lived paycheck to paycheck, so they simply allowed them to pay in installments.
Okay, I have to stop you there because you are framing these moves as mere operational or financial adjustments, and I argue they were the foundation of an information edge.
How is an installment plan an information edge?
Because by 1956, they had founded Progressive Casualty Insurance Company with a mere 40 employees and a tiny $2.6 million in written premium. That scale is irrelevant compared to the strategic break it represented. They were the first specialty underwriter of non-standard insurance.
Okay.
When you view the 1964 payment plans and the drive-in claim centers through the lens of pattern recognition, they weren't just solving billing friction. They were building early data capture mechanisms.
You're saying the billing was the data?
Yes. How a customer pays, whether they make monthly installments on time, whether they require grace periods, whether they pay in cash or by check, is a behavioral signal. How they interact with the drive-in claim center is a behavioral signal.
I see.
Every single interaction was a new way to measure a driver's reliability. They were gathering proprietary data on a discarded demographic, laying the groundwork for the modern machine. They discovered that broad categories create mispricing, and mispricing creates opportunity, provided you can survive long enough to harvest the data.
I think calling it an information edge in the 1950s is reverse engineering a grand tech narrative onto what was just a really strict bookkeeping. They were not tech visionaries in the mid-20th century. They were just cheap and highly disciplined.
Discipline that generated unique data.
Sure, but surviving off this discarded market created a new problem, which was scale. You cannot run a mom-and-pop operation on ugly risks forever without a rigorous financial engine. And that is the problem Peter B. Lewis had to solve when he took over the company in 1965.
The way he took control is telling too.
Very telling. He executed a leveraged buyout with his mother, borrowing roughly $2.5 million and pledging their family stake as collateral. Peter Lewis inherited a scrappy, niche insurer and proceeded to completely reconstruct the financial architecture of the company.
He actively rejected the intellectual laziness of the entire insurance industry. Let's ground this for the listener, because the concept of a combined ratio is the absolute heartbeat of the insurance industry. If you collect $100 in premiums and you pay out $70 in claims and $32 in operating expenses, your combined ratio is 102. You are losing 2 cents on every dollar of insurance you write.
And the standard industry model was, and in many legacy carriers still is, to tolerate underwriting losses of 102 or 104, right? And make all your actual profit by taking those premium dollars and investing the float in the stock and bond markets. Lewis looked at that model and refused to play the game. He demanded that the underwriting operation itself must be strictly profitable, independent of the stock market.
Which is a completely radical posture for a financial institution of that era. By deciding that underwriting must carry its own weight, Lewis shifted the entire internal gravity of the company away from asset management and toward risk measurement.
The architectural masterstrokes followed immediately. When Progressive went public in 1971, Lewis stated a hard objective to the market, a 96 combined ratio. He publicly committed that Progressive would extract 4 cents of pure underwriting profit on every dollar of premium.
4% doesn't sound like much until you realize the rest of the industry was intentionally losing money on the same metric.
Exactly. Then, in 1977, they became the first auto insurer to voluntarily publish their loss reserve report. In 1979, they launched Proteus, their internal data processing system. I argued that these supposedly dry financial moves are the actual secret sauce.
The engine for the data.
Right. Compare the rollout of Proteus and reserve transparency to building a perfectly calibrated engine. You cannot scale non-standard risk without a flawless actuarial architecture. What was the rest of the industry using in 1979? Paper files, analog ledgers, actuaries estimating severity trends with a pencil and a slide rule.
And Proteus digitized that workflow.
It digitized it, and publishing loss reserves forces an unyielding discipline on your actuaries. It eliminates the temptation to smooth earnings or hide bad pricing decisions in opaque accounting buckets. It ensures the machine is perfectly tuned to reality.
But have you considered what that 96 combined ratio mandate actually did to the culture of the organization? It was not just good accounting. A mandate of a 96 combined ratio forced the company to become a measurement system whose output merely happened to be policies.
A measurement system.
Think about it. If you absolutely must make an underwriting profit on a non-standard driver, you can no longer rely on industry averages. You have to measure that specific driver with a level of granularity no one else possesses.
I'll grant you that the granularity was unmatched.
And once they built that internal measurement system, they began to weaponize it outwardly against the rest of the industry. This is where the behavioral data science pattern becomes undeniable. They realized they could use transparency as an offensive strategy.
You're talking about the 1990s initiatives?
Yes. In 1990, they established an immediate response capability for claims. In 1993, they became the first auto insurer to offer comparison rates. And then in 1994, they launched 1-800-AUTO-PRO.
The 24/7 telephone service that gave consumers a progressive quote alongside the rates of up to 3 major competitors.
Think about this for a second. Imagine it's 1994. You are sitting in your kitchen. You need car insurance. Normally, you call a local broker, they give you a price, and you take it. Because shopping around means making 5 different phone calls during business hours and repeating your driving history 5 times.
It was a massive friction point.
Huge friction. So Progressive launches a 1-800 number. You call it. You give your information once. The voice on the other end says, "Our price is $800. State Farm's price is $650. Allstate's price says $700.
They literally gave you the competitor's cheaper rate.
Yes, a company is spending their own money, staffing their own call centers to explicitly tell you to buy a product from their direct competitor. Why would any rational business do that?
Well,
Because they were training the market to shop on data, turning price discovery itself into an intelligence-gathering operation. If a competitor's price was lower, Progressive lost the sale, but they gained an exact real-time map of their competitor's pricing model. More importantly, they used this mechanism to selectively adverse select the rest of the industry.
okay, let's pause on adverse selection for the listener. This is a term economists and actuaries throw around, but the mechanics are fascinating.
It's ruthless.
It is. You called the hotline. Progressive's deeply calibrated internal model knows that you are actually a terrible risk, likely to cause a massive accident within the next 12 months. Their model prices you as $1,200. But State Farm's blunt, traditional model does not realize you are a terrible risk. State Farm prices you at $650.
And Progressive doesn't even try to win you over.
Progressive does not try to match the price. Progressive cheerfully says, go with State Farm. Progressive just actively let the competitor swallow a toxic, money-losing driver. They allowed the bad risk to slowly poison their competitor's balance sheet.
That is weaponized adverse selection. They rearrange the entire flow of information between risk, customer, price, and service. They turned quoting into an intelligence network.
See, I view the comparison rate strategy as a ruthless acquisition funnel, not an abstract intelligence network. They sliced risk finely, found the profitable pockets, and use their operational speed to capture them.
But the speed comes from the data.
And from the operational setup, they used claims handling to shrink the lag time between an accident and the repricing of risk. If you resolve a claim immediately, you update your severity estimations faster than a legacy carrier that takes weeks to process the same event.
True.
This relentless operational gearing culminates in the staggering results we saw by late 2025. Progressive reached 38.6 million policies. They became the second largest personal auto insurer in the country.
The numbers are incredible.
The financial metrics are almost unbelievable. A December combined ratio of 87.1, with the fourth quarter resting at 88.0. In an industry where a 99 is considered a good quarter, an 87.1 is absolute actuarial dominance. They are keeping nearly 13 cents of pure profit on every premium dollar.
Which is unheard of.
But I want to challenge your central premise regarding the technology they deployed to get there. I am talking specifically about telematics. I see the progression from early devices to Snapshot. But is telematics truly a paradigm shift?
Absolutely it is.
Isn't Snapshot just a better, highly digital version of asking a driver their age, gender, and zip code? You are swapping demographic questions for a piece of hardware, but it is still fundamentally just underwriting?
That minimizes the profound technological leap that occurred. Telematics is not a better version of asking someone's zip code. It is the complete eradication of proxies.
Eradication of proxies.
Yes. When you ask for an age, a zip code, or a credit score, you are asking for a proxy that correlates with the probability of an accident. You are guessing.
Educated guessing, but yes.
When you measure the actual G-force of a vehicle braking at 2:00 a.m. on a Tuesday, you are no longer dealing with probability proxies. You are measuring physical reality. Trace the lineage of this usage-based category. It didn't happen overnight.
It took decades.
It was a multi-decade obsession. It started with Autograph in 1996, then TripSense in 2004, MyRate in 2008, Snapshot in 2010, and finally the shift to continuous mobile app monitoring in 2022. This is a fundamental category shift. The car itself became the underwriting file.
That's a strong claim.
Tricia Griffith, their CEO, explicitly stated that usage-based insurance is their most predictive rating variable. Internal leadership confirmed it carries more than twice the predictive power of traditional proxies.
Twice the predictive power of a century's worth of actuarial science. That is staggering.
And this creates a compounding flywheel that legacy carriers cannot mathematically catch on a static basis. Better behavioral data leads to more accurate rate pricing. More accurate rate pricing allows Progressive to write seemingly ugly segments profitably.
Because they know exactly who is actually ugly and who just looks ugly on paper.
Exactly. Those new drivers generate more premium and more telematics history. That richer history refines the next round of pricing. The traditional industry was comfortable putting people into broad demographic boxes. Progressive shrank the box until the box became the individual driver. That is not just underwriting, that is the deployment of a self-feeding sensor network.
Well, that brings us to a critical junction. If the machine is as perfect as you describe, what happens when everyone else figures out how the engine works? We are looking at a structural wall in the market right now.
The diffusion of the technology.
The secret is out. Diffusion has occurred. State Farm has Drive Safe and Save. Geico has Drive Easy. Every major carrier, from Allstate to Nationwide, has deployed some form of usage-based insurance.
They have.
Because the technology is now essentially table stakes. I argue that the competitive moat reverts entirely back to traditional operational discipline. The winner is no longer the one with the novel sensor. The winner is the one with the fastest state regulatory filing speed. The winner is the one with the most trusted brand, the most efficient claims processing, and the lowest expense ratio.
I see your point.
But there is another dimension to this wall, which is the emotional and psychological friction of perfect measurement. Let's look at what happened in 2014 when Progressive began adding surcharges to Snapshot customers.
The privacy backlash.
Exactly. For years, telematics was marketed purely as a discount mechanism, a fun, gamified way to save money on your insurance. Then Progressive applied the inevitable actuarial reality. If a variable predicts risk accurately, you have to penalize the bad drivers just as much as you reward the good ones.
The math requires it.
The math is perfect, but customers absolutely hated it. If you are listening to this right now, think about your own driving. You might consider yourself a safe driver, but would you want an application tracking exactly how hard you hit the brakes when someone unexpectedly cuts you off in traffic?
Probably not.
Suddenly, perfect math feels like a punishment. It turns out people actually want the illusion of a broad social pool. They do not want a perfectly priced, dynamically updated private contract that punishes them for a rainy afternoon commute.
The privacy paradox is very real. It is the fundamental tension of the information edge. The better you measure someone, the more you look like a surveillance company, rather than a reassuring financial safety net.
Right, it feels invasive.
It does. But I push back on the idea that the Moat simply reverts to traditional operational metrics just because other companies downloaded the blueprint. Look at the larger pattern. Progressive is operating on the exact same trajectory as Capital One did in the credit card industry.
Capital One.
Yes, Capital One applied rigorous, scientific, multivariate testing to credit offers in a market that was entirely dominated by conventional, flat pricing. They both won by treating a blunt, legacy industry as a continuous behavioral experiment.
Okay, I follow the parallel.
The threat to Progressive's Moat does not come from State Farm finally figuring out how to use a telematics application. Legacy carriers will always struggle to integrate dynamic data into static legacy mainframes. The true threat comes from modern descendants who are native to this new reality.
You mean the insurtechs?
Look at Root Insurance. They attempted to build a software-native carrier entirely around telematics from day one, without the legacy baggage of traditional proxies. Or look at an even more radical parallel, Tesla Insurance.
Tesla is a fascinating case because they are attempting to collapse the supply chain of risk entirely. They are removing the third-party financial institution from the transaction.
Progressive spent 30 years trying to turn the car into a sensor. Tesla inherently owns the sensor. They own the hardware stack, they own the software. They own the steering angle telemetry, the autonomous disengagement data, the pedal misapplication rates, and the entire behavioral pipeline.
It's natively integrated.
Tesla asks a terrifying question for traditional insurers. What if the manufacturer becomes the actuarial model? Progressive won because they invented a new resolution of reality in a blurry industry. But what happens when a hardware manufacturer inherently possesses a higher resolution than a financial institution ever could?
As we synthesize these perspectives, it becomes clear that Progressive stands as an unparalleled case study in corporate strategy. From my vantage point, they remain the ultimate testament to underwriting discipline.
The operational powerhouse?
They prove that if you are willing to measure the precise details that incumbents ignore, and if you demand an unyielding margin anchored by that relentless 96 combined ratio, you can build a financial empire out of the very risks the rest of the market discarded. They did not win by avoiding risk. They won by structuring it better than anyone else in history.
My conclusion is that Progressive's true legacy is entirely conceptual. They proved unequivocally that any industry relying on broad, inherited human categories is inherently vulnerable.
Vulnerable to measurement.
Exactly. If your business model depends on blunt labels and demographic proxies, you will eventually be dismantled by a competitor who learns to see the world at a higher resolution. Progressive did not just sell insurance. They changed what the market considered measurable.
The future of this space clearly hinges on a massive collision. Can the superior execution of a known concept, Progressive's compounding decades of telematics data, massive brand presence, and regulatory discipline, outlast the native challengers who own the hardware and the software from inception?
It's the ultimate test of their model.
It leaves us with a compelling question for anyone analyzing complex markets. Are you operating on blunt categories, or are you building the sensor network that will replace them? This is the Research Desk officially signing off.